why would someone benefit from putting their purchase in an LLC versus just their name?
So the benefit of an LLC is that it'll live on beyond the life of the person who's the owner. So if you're buying an investment property and your family wants to continue on the property without doing a transfer, without having to pay transfer tax, then you can pass it by passing ownership of the LLC. And the other benefits of the LLC is, especially if you're renting the property, is you're limiting the liability. So in a perfect world, if cost is not a factor, then you might want to have a separate LLC for each property. That way all of your wealth is not at risk for anything that might happen at one property, like for example, a gas explosion, or back in the day there used to be lead poisoning exposure, sometimes asbestos. So by having each property in a separate LLC, your wealth, your risk is limited to just that property.
And it could be something as simple as, you shared this with me before, Bill Jones 1 LLC, Bill Jones 1 LLC, Bill Jones 2 LLC. It could literally be that simple for each individual property to have its own LLC to protect them, right?
And that way the owner of the property is always the shareholder in the LLC. Right, and it could be, and again, we're being specific saying LLC, which stands for Limited Liability Corporation. It could be any form of corporate structure. If you have a group of investors, you might not be limited to an LLC. You might want to do just a regular corporation. And the other benefit of that is it gives you a clear path to keep all your bills and expenses tied in together, so there's no commingling. So if it's a business deduction, you'll have a nice clean path when you go to your accountant to file your tax return and making sure you're getting all the deductions.
Love me an LLC. Okay. What would the trade-off be between choosing a right of survivorship on a deed versus just willing a property when it comes to taxes?
Well, I think first we have to recognize that there's a couple different ways you can own property. I think we have to start with the format. In Pennsylvania, we recognize a format called tenants by the entireties. That requires a husband and wife relationship, a legal marriage. With that, you have unity of time and title. So most people think that husband and wife own property 50% each, when in fact, if they own it by the entireties, it's 100% each of them. So that means it's indivisible. So any debt or any obligation that any one of those spouses owns cannot be separated from the other. So that's good. That's a good thing. It also guarantees that if one of them dies, the other one automatically inherits all the rights to that property. So that's a unique form of joint ownership that's limited to spouses. The second tier is joint ownership. Joint ownership happens in two ways. You can have joint ownership with right of survivorship, and in that case, the parties have to have an equal share in the property. Could still be 50-50, but if one of those partners dies, then the other partner inherits the property. But you don't get all the legal protections of both owning 100%. You'll each technically own an undivided 50% share if there's two owners. And in tenants in common is the third category, where if it's different shares, somebody might own 60% and somebody might own 40%, then those shares can be passed by a will to anybody they want. Right. So your question was about doing survivorship in the property. When you do survivorship in a property, then it keeps the property out of the will. However, it doesn't save you any money. You're giving away a future ownership right, but you'll still own the inheritance tax on the property. And also, if you give it by giving a joint ownership with right of survivorship, instead of just saying when I die, this property goes, that's a beneficiary. A survivorship usually applies to a joint owner. So if you give it away jointly during the lifetime, then that person that you gave the ownership interest to shares in your acquisition cost, which is used to calculate your capital gain. So in Pennsylvania, if you jointly own property and you title it to your children, they will pay 4.5% inheritance tax when they inherit the property. But if you give it to them while they're alive, and then when they go to sell the property, they'll have a capital gains based on what you paid for it when you first bought the property. And capital gains tax is more typically 26 to 35% of
it's much higher.
The increase in value. Yes.
So it does make more sense for the average family who's saying, I want to pass, my property down to my child or my grandchild, to just will the property hypothetically, right?
Right.
I mean, obviously everything's circumstantial. You should definitely have a conversation with the attorney separately for your individual requests and needs. But if you're just somebody who's wanting to avoid paying as much taxes as you can and pass your property on to your child, it may make the most sense to just record it in a will to your child.
Right,
will.
so even though we're talking mostly about real estate, I can distinguish the will versus real estate. If you put somebody's name on the deed, then if you give them an ownership, you can't transfer it out without them signing off. They become an owner. So if for some reason, if you were doing it with your child, and if your child is then subject to a divorce action, or maybe collection of costs from a criminal case, or any kind of problem, that can be charged to them. So you won't be able to go back and change that unless you change the deed. And that means that you would trigger a new need for a new title search to make sure you have a clean title that you're changing when you change it, and you'll have filing fees and so forth. Whereas a will does not get recorded until somebody dies, and then you can change that will at the drop of a hat. You can change your will once a week if you want to, as long as you're willing to pay some money to your lawyer.
So let's dive into that hypothetical a little bit more. So my daughter's 3, she'll be 4, and let's say I add her to the deed as a right of survivorship on my property. Fast forward 20 years, she's getting divorced and maybe is having money problems. This is the point you just brought up a second ago, where this could be an issue because she has ownership in her property now.
Correct. So if that were happening here in Pennsylvania, then when she's dealing her divorce, they would look at that as an expected future asset of hers, and that would be a set aside that she would be credited to, so that her husband, if he doesn't have a beneficial interest in a separate parcel of real estate, they might offset her interest in that by giving him more of the marital estate.
Mm-hmm.
So he wouldn't have a direct claim to the property, but it might cost her in her ability to collect from the marital estate. Notwithstanding that, if she's only named as a survivor, as a beneficiary, and not a joint owner, that you could still change it, but she would still lose the benefit of that.
Very interesting.
One question.
Right. So then again, just to be clear on our terms, there's 2 types of trust. There's a testamentary trust. So if you leave it to her in her will, we put a paragraph in there that says, if anybody inherits property under my will and they're under 18, then I designate somebody to hold it in trust for that person until they're of legal age, versus a living trust where you have to give away the property during your lifetime, and then it's held in trust, and then it's no longer tied to your death.
Does this still work the same way with an LLC? If I wanted to put all my properties in an LLC and leave it to Katori, and she's underage, how does that work?
You would put the shares of the LLC in trust for her, right? So she would indirectly own the property because the LLC owns the property, and she would own the shares of the LLC.
Wonderful. So if there's ever a conflict in the will and the deed, which one supersedes the other? Meaning, the will says I'm going to leave my property to my brother, but the deed says Katori's name is on it, my daughter.
We don't look to any property in the will that already passes on the face of its own title, and that applies in both real estate and bank accounts. So if you have a bank account that says mom and daughter, even though there's still an inheritance tax, that's not a part of the estate. So if you have a bank account that says mom and daughter, then daughter inherits that at the moment of your death. And then if you have a will that says I give everything to my daughter and my niece in equal shares, your daughter still gets an equal share of everything in addition to whatever passed by virtue of the title. So the same thing is true of the real estate. So it passes immediately without touching the will. And I don't know if I exactly answered your question. So the deed is the official title of the real estate. Nothing can interfere with the deed. So if the deed is clear, then that's the only document that states who owns the property. And that's so that title companies and title insurers and buyers can all know that that's the official status. So that's why we record them, and that's why all that information is public available, so that people can be guaranteed that they're getting the maximum amount of title that you can own in real estate.
Absolutely. When it comes to legally what you should be recording, how or why, you should definitely be contacting an attorney like Bill to make sure that you've got everything lined up for your assets, for your family.